Alright, so I'm going to start working through this sample published accounts question. So just like a section 1 question, I'm going to start by doing my adjustments and workings. Okay, so I've got a trial balance here. It's short enough, as I said, some stuff is summarized like distribution costs and admin expenses, rather than listing out a lot of different expenses. But into my additional information, there's my closing stock. So that's going to go into my cost of sales, and it's going to go into my balance sheet. It's going to go under current assets, kind of on its own as stock. My cost of sales, so normally I would be putting that on the profit and loss account as a separate item. In these questions, I total my cost of sales separately and bring that in to the profit and loss account. So that's the first working I will do then. Is my cost of sales, because I'm going to total that separately. And then alright, so look, you can list these out: opening stock, purchases less closing stock. Kind of do it properly. I'm just going to add them together and put the numbers in here. So what's your cost of sales? It's your opening stock, so I get that from the trial balance, so that is 1.3 million. Plus your purchases, so that's 12.3 million. Less closing stock, 1.38 million. And normally that's it. We do see one or two other things in cost of sales sometimes. There is one that comes up in these questions a lot. So I'm just going to leave this open for now, and I'm going to see if that comes up later in one of the other notes. As I said, there's a really common one that comes up in these questions. Part B then, depreciation was to be provided for as follows. Buildings, 2% of cost per annum, and there were no additions or disposal of buildings during the year. However, land belonging to the business, which cost 110, was sold for 270. Also take into account that at the end of the year, the company decided to revalue their premises at the true market value, which is 1.5 million, and the directors decided that this value should be incorporated into the accounts of the business. So, a good bit going on here. So land belonging to the business, which cost 110, was sold for 270. So that's a profit of 160. Profit on sale of land 160. So that's given in. So that's already been accounted for and put into the accounts. Okay, that's going to be put in as an exceptional item when we come to the profit and loss account. But we don't need to do anything with that because it is already put into the accounts. Let me see now. So 2% of cost per annum. So this year's depreciation charge. So building depreciation. So buildings of cost are 1.4 million. Multiplied by 2% is 28,000. And that's this year's depreciation. Okay, so what do we need to do with that? We need to put that into our expenses. So I'm going to do my admin expenses note here, or working here. So admin expenses, I'm given 1.484 million. But now I've got 28,000 depreciation. Again, just from experience and doing a few of these, you'll see there's another couple of things you tend to add on to admin expenses. So I'll leave that working open, and I'll return to it when I get to a later note. What else do I need to do? Well, they're revaluing their premises. So that's going to give me a revaluation reserve. So let's do my reval reserve. So the accounts at the moment, or the buildings at the moment, are going to be in the accounts as 1.4 million. Take away accumulated depreciation of 96,000. What we're going to do is change this value from 1.4 up to 1.5 million. Okay, so my revaluation reserve is going to be made up of 100,000. So that's the increase in the value from 1.4 to 1.5. When I revalue the building, I want to clear out the accumulated depreciation that's there. So that 96 is going to move out of accumulated depreciation into the revaluation reserve. All right. And then I also did depreciation this year for the buildings. So this revaluation happens at the end of the year. So the revaluation happens after this year's depreciation. So I need to clear out this year's depreciation. So it's kind of, I'm charging it to the accounts, but then at the end of the year, I'm immediately moving it into the revaluation reserve. So the 28,000 is going into revaluation as well. Okay, so it's the uplift in value, the opening accumulated depreciation, they'll kind of always go in. And in this case, because I depreciate for this year and then the revaluation happens at the end of the year, I should move that depreciation. If you think about it, it wouldn't make sense to revalue the building to 1.5 million and then immediately have 28 grand taken away for depreciation. So we're saying at the end, the very end of the year, it's worth 1.5 million. So that's what it should be in the accounts as, 1.5 million, not 1.5 million take away depreciation. All right. So that's kind of 28 grand depreciation on this. And then at the end of the year, we revalue it. So we move that out. So total those on that revaluation reserve then is 224. All right. So that's going to go down in the kind of what will be the finance by section at the bottom of the balance sheet. Is there anything else I need to do with that one? No, there's not. If I go on then to my third working, so directors propose that the provision should be made for directors' fees of 160 and auditors' fees of 18,000. So the audit of a company's accounts, the auditors coming in and checking the accounts, that happens after the end of the year. So it's obviously not paid for before the end of the year. So it's not included in these expenses. So that's why we're providing for it now. And you'll always see that in these questions. The director's fees as well, they tend to be kind of based on the results of the company. So how did it do? So we tend to kind of charge, they come in after the end of the year. So they're just kind of providing for them here, saying, we think we're going to pay the directors 160 grand. We think we're going to pay the auditors 18 grand. So they're not included in the accounts. So I'm going to have to put them in now. So directors' fees and auditors' fees, both of them are going to go in to admin expenses. So that's why I left that open. So I'm going to add those on. So I suppose I'm doing these quick by just putting the numbers in. I suppose the ideal will be if you kind of listed them down and call that director's fees and call that auditor's fees. But I guess if you're in a hurry doing them like this, might be the way to go. Right, they're going in as expenses, but I haven't paid that 160 yet, and I haven't paid that 18. I'm only providing for them. Okay, so I still owe. I'm going to owe that money at the end of the year. So they need to go in as creditors. And remember, in the creditors, you're going to list trade creditors, which is just your kind of purchases. You're going to list your tax that you owe and other creditors. So other creditors is kind of a catch-all there. There isn't any kind of other creditors trial balance item. So we're going to start it here. So other creditors. And the 160 and the 18 are going to go in there. All right. D then, the company's corporation tax liability as determined by the revenue commissioners was set at 340. So again, the tax liability is kind of decided after the end of the year, after you can see the company's profit. So we don't know what it is while we're doing the account. So this is us providing for it. Our tax liability is going to be 340. So that's going to go in your profit and loss. So after interest, you put in the tax of 340, and it's also going to go, so 340 equals the tax creditor So taxation goes in as a kind of separate item under creditors, amounts falling due within 1 year. E, provide for unpaid debenture interest due at the end of the year. So they're telling me that I haven't paid all the debenture interest. So there's 24 grand in there for debenture interest paid, and I've got 8% debentures. This is telling me when they're when they're due for repayment. So 2005, 2006. I'm doing them for 2000. So just sometime in the future. That's all that is after it. It's when they need to be paid back. 800 grand then at 8%. Okay, so there's no mention of that being issued halfway through the year or anything like that. So it's a full year, 800,000 by 8%. So 800,000 multiplied by 8% is 64,000 debenture interest. So that's what goes into the profit and loss as interest. So interest does go in as its own line item on the profit and loss. And then I've paid 24 of that. So this is the kind of adjustment we see over and over again. We're very familiar with this. So that means 40,000 is debenture interest due. Okay, I don't put in a separate item, interest due, in my creditors. Okay, I'm going to put that 40 in with my other creditors. All right. Next one then. During the year, the directors paid a dividend on shares as follows. A full year's dividend was paid to preference shareholders and the remainder to ordinary shareholders. So what this is telling me is, there's dividends paid of 111,000. Some of that is ordinary shares and some of it is preference shares. Okay. The preference shareholders, they get their 7% dividend every year regardless. Okay, and then depending on the results of the company, we might pay the ordinary shareholders a greater or lesser dividend or no dividend at all some years. Okay, so the 600,000 by 7%, that's kind of guaranteed to be paid. So that's included in the 111,000. So 111,000, take away 600,000 by 7%. So that's 111,000, take away 42,000. And that's 68,000. So that's your ordinary dividend. And this 42 grand is your preference dividend. This isn't important for the actual profit and loss account. You are just going to put in the 111,000 there. We're not going to go into this detail here. Maybe they're going to ask us for the dividend note. So as one of those 4 or 5 notes, you can be asked to provide the dividend note, and you will just say the 111 dividend is 42 grand preference, 68 grand ordinary. So you kind of split it up in the note. So that's what that piece of information is for. Let's just look actually. Yeah, I'm asked for the dividend note, so that's what I need to do that for. Next is, okay, so the listed investments are in listed companies and have a current market value of 960 grand on the last day of the year. There were no new investments or investments sold during the year. So my investments, so I've got fixed asset investments of 600,000. They're telling me they have a current market value of 960. This is a little bit of a red herring, okay? So they're trying to tempt you to do here is, they're in the accounts of 600, they're worth 960 now, they want you to maybe put 960 in the balance sheet. You don't do that, okay? You leave them in there at cost. It is the 600 that is going to go into the balance sheet. This 960 would be disclosed in a note, okay? So you would say in your note, I have fixed asset investments at cost, listed investments of 600,000. They have a current market value of 960, but you don't put the 960 in the balance sheet. Okay, so look, like listed investments, they're going to be shares in companies. They can be a bit volatile, they can go up and down in value. So we're not going to kind of recognize the fact that they've gone up to 960 in the balance sheet when they could go down again quite quickly. Okay, so we're a bit more cautious about recognizing profits and gains than we are losses in accounting. We try to be cautious, we try to be prudent. So we don't put this 960 in, and as I said, it's them kind of tempting you. You will need it for, I don't think they ask you for it. Yeah, they don't ask you for the financial fixed assets note, but if you were asked for it, that's where it would come in. Okay, so it's the 600 that goes in the balance sheet, but in the note you would say that 600 has a current market value of 960. Okay, but we don't need it for this actual question because we're all asked for that note. All right. Last two adjustments then. So on the 12th of December, the company receives a letter from a customer of the business who had a fall on the company's premises during the previous month. Company is making a claim against the customer is making a claim against the company for damages. The company's solicitors, this is important, believe that the company is unlikely to be liable. They have estimated that any liability would be a maximum of €50,000. So if our solicitors tell us that the claim is unlikely to come to fruition, we're unlikely to be liable for this 50,000, then we don't put it into the balance sheet, we don't put it into the profit and loss. Okay, you'll see here they ask me to put in a contingent liability note. Okay, so even though you're saying I'm unlikely to have to pay this 50 grand, you might. Okay, so this is going to go to the courts. The judge might decide, no, your solicitors are wrong, you owe the 50 grand, and then I'd have to pay it. Okay, because there is that chance you'd have to pay it, you put it in as a note. Okay, and you basically write this out again with a little bit more detail. I'll do the notes in a separate video, but you'll be saying, solicitors say it's unlikely to happen, but I could have to pay out 50 grand as a result of a legal case. All right. If the wording of this was the company's solicitors believe the company is likely to be liable, if the solicitors think I'm going to lose this case because this fall happened during 2000, I would need to put it in the 2000 accounts. So if they said likely to be liable, I would put 50 grand in with my admin expenses, and I would put 50 grand in with my other creditors as amounts, as you know, an amount I'm going to have to pay out, something I owe. All right, so unlikely to be liable just goes in the note. So might have to pay this out. Likely to be liable, you put it in the accounts. So as I said when I was talking about the listed investments, we are cautious, we're prudent when we're doing accounting. So if we think we're likely to have to pay it out, we put it into the account straight away. Okay, so just be careful of the wording. You'll see those as you go through questions. Some unlikely, some likely, and the two different treatments. Last one then, so the patent was acquired a number of years ago and has been amortized over 10 years in equal installments. It cost $480 originally, and this amortization should be included in cost of sales. Yeah, so this is one you see really often. This is why I left the cost of sales working open up here, because the patent amortization is put in with cost of sales a lot in these questions. All right, so you'll see this a few times. So patent has been amortized over 10 years. And it cost $480. So 480 divided by 10 is 48,000 amortization. All right. What do I do with that? They are telling me to include it in cost of sales. So I'll add the 48,000 up here, and then if you add your cost of sales together, you're going to get 12,268 000, and then the other place the amortization goes is it will reduce the patent that's there. So where is patents? Yeah, here it is. So at the start of the year, patents were valued at 336. So that 480 grand patent has been amortized already a good few times, and it's already down to 336. So we're just going to take another 48,000 off that. All right. So 336,000 take away 48,000 is 280. 8. And that is my paid. So that's going to go in as your intangible assets on the balance sheet. All right. And that's it in terms of notes. So you see they are a good bit quicker than the section 1 adjustments that we see on a final accounts question. That's kind of it done. So next video will be the profit and loss.